Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty, and I'm doing our housing weekly market update. Make sure you're subscribed to our YouTube channel, Facebook, Instagram, all the good things like that, so you can follow um, everything that comes out, including even shorter informational videos that come out too. Make sure you're following us on all our social. Okay, I'm going to jump right in here and let you know. Hey, if you didn't get the buyer advisor guide, let me know. I'll send it out to you, or I'll include it in this week's email again, so that you have that. It's a great resource for home buyers. So I'm going to jump right into this video. The big news this week was the new Fed chair did his first meeting, and here are the five big takeaways from Kevin Warsh's first meeting as the Fed chair. And we kind of told you some of this stuff was coming, but not a rate change yet. Not surprising. The war conflict was just signed off on as far as the memorandum of understanding. Hopefully that all works out and Iran plays nice. So we'll see how that all goes. But no rate change right now, but the Hawks are circling. Basically, this has to do with the fact that the rate of inflation. We know everything costs more, but the rate of inflation is too high. A lot of that has to do with the supply shocks. But even taking that out, there's still some questions to the rate of inflation. What Kevin Warsh has said is he wanted to make these changes coming in. We already kind of knew these things were going to happen, but um, here we go. There were no apparent dissidents to keep the Fed's fund rate targeting between 3.7 or 3.5 to 3.75% for the Fed rate. And we know 65 to 75% of where mortgage rates go is based on Fed policy. Okay. Fed messaging, all that. So we're going to get into some of the messaging stuff here. And that's this first thing is, however, dot plot expectations further outshowed an inclination toward a hike later this year. The Federal Open Market Committee split 9-9 between those expecting steady rates or one cut and those seeing at least one hike, with the median dot pointing to a quarter percentage point increase. Basically, the dot plot, they're going to be that's kind of going into the next thing. They're going to be getting rid of that, and that is kind of where the Fed governors are on this dot plot. Kind of tells you what they're thinking. They're going to be getting rid of that because it causes some volatility in the market that's unnecessary. So that's going to be part of the change. The dot, it says number two, the dot mystery solved. So they're keeping the Fed rate where it is. Okay, that was to be expected, really. Just kind of hold and wait and see. Number two, the dot mystery solved. There was rampant speculation heading into the meeting that Kevin Warsh wouldn't be submitting a dot, and he confirmed that he did not. In the past, the chairman was expressed a disdain, has expressed a disdain for such forward guidance as hamstringing future policy. It's been the practice, this committee, for participants to submit these projections. And I have encouraged my colleagues, he said, to continue to do so. However, I have, however, refrained from offering any projections of my own consistent with my long held views of the ESP, uh, at least as currently structured, he said. So he's not getting involved in this forward guidance thing. He's basically kind of sending a message that he doesn't believe in that forward guidance because things change in the marketplace, right? There could be a supply shock, which is really different than inflation, but it does cause the price of things to go up or down, right? So that's one of the things they're going to be looking at. But this dot plot thing is a big deal. And it causes some volatility in the market when it's put out. So he wants to kind of, get away from that. Number three, the regime change via task force. Warsh has been promised to shake things up at the Fed, and his first steps in doing so came through the announced formation of five task forces. forces. They are charged with studying communication, the Fed's balance sheet, the data sources on which it relies. Okay, that's been a big thing. I've told you this a million times. They use very antiquated ways of doing these surveys, which surveys are kind of not very accurate to begin with. They don't get the information back very timely. You don't get information back from everybody. Um, a lot of this information too is done through phone calls where you call people and ask them, how much do you think your home will rent for? Well, a lot of people don't even know that. The basic person who's just, busy with work and family and stuff, they don't really know that. They may not really know how much their home could rent for. So that's something that goes back to the 80s, owner's equivalent rent. And in today's world where we have, all, these MLSs and real-time data and AI, those sorts of things are completely outdated. So they're going to be looking at communications, the Fed balance sheet, which has been horrendous, data sources on which it relies, productivity and jobs. And kind of get the sense that they wish, the dual mandate was a one mandate just on inflation and not so much heavy on the full employment thing. Okay, because sometimes they're counter odds with each other, and it makes it difficult to really set this type of policy. Um, so the data sources, the productivity and jobs, the impact of artificial intelligence and other transformative technologies, and the central bank's inflation approach. Kevin Warsh has said many times that he's more interested on the left side of the decimal point than the right side of the decimal point, meaning, you know, when you go back to basically the early 20th century, into like all the way back to 1919, and you average it out, the average inflation rate has been over 3%. It's, you know, anywhere from 3.3 to 3.8%. Excuse me. So this 2% target that originated out of an economist from New Zealand, who, I don't know why we're listening to an economist from New Zealand, but that's where that 2% target came from. Maybe it needs to be more of a range. So they're going to be looking at all these different things. We told you that a lot of this stuff could change in the future, and I think it's a good thing. Not that we want to see inflation go out of control, but we also need to be realistic on our targets and metrics and where we're getting the data from, and all these different things. So and how they're communicating. This could have been. We'll wait and see, but this could be the last or one of the last actual pressers that we'll see from the Fed chair. That's something that's being speculated and kind of what he may be alluding to, but we'll see what these task forces come up with for a communication strategy also. So, uh, tough on inflation. He mentioned number four. On about a dozen occasions, Warsh used the term price stability. Okay. For a chairman, he said, uh, you know, who had opinion often about cutting rates, it was surprisingly hawkish talk about his and the committee's unambiguous and unanimous resolve to get inflation under control. Markets responded in kind with the policy sensitive 2 year Treasury yield soaring by 14.4 basis points. Okay. So this is an interesting take because, in the past, he's always been known as being very hawkish, meaning that, he really, was big on taming inflation, keeping that inflation rate down, maybe being more tend to raising rates. Uh, but we call it Kevin Warsh 2.0 under President Trump. We may see a difference there, but he was very keen on keeping price stability. Okay, so we'll keep an eye on that. I think once we get some better data, a lot of this is going to change because, again, what a lot of the information that Jerome Powell was looking at was old, outdated rear view mirror information. And I've mentioned this a million times, but I'm going to mention it again. And I've shown the chart a million times. I don't have it today, but the shelter cost under this owner's equivalent rent, if you're going by that, has plummeted over the last 3 years. So looking at that, which makes up a third of the inflation rate, okay, not inflation, but the inflation rate. Gotta stress that it's the inflation rate. We're at a whole new price level after the pandemic. Okay, that is what it is. We don't want deflation either. And as Logan Mohtashami puts it from HousingWire, a healthy economy has some inflation, not over hyperinflation, but some inflation. And it's just getting all these data points, the correct data, the real data, the underbelly of the data, not the supply shocks and everything, because inflation is too many dollars chasing too few goods. Print too much money like we did during the COVID pandemic. And then again, after that, you have a lot of issues with inflation. Okay. It's just how it works. So we have to look at these. And he is really honing in on this, but you have to have the correct information and you have to kind of look at where things really are in the now, not, you know, a year and a half, 2 years ago. Okay. Yeah. You might want to see and track that, but that's not what we're setting policy today. Okay. And this is a lot of what Jerome Powell was missing. And so we'll see how it all works out. But I think now we're going to talk about it, but with oil prices coming down as much as they have, that's going to affect everything in the market, which is a good thing. 10-year treasury, the 2-year treasury, it's going to affect mortgage rates. It's going to affect Fed policy. So number 5, um, brevity is the soul of wit and monetary policy. Warsh also promised to revamp communications, and the first visible step was dramatically abridged post-meeting statement. Prior to the new chairman's arrival, the statements generally ran in excess of 300 words, consistent of boilerplate language that investors parsed through closely. This time, the statement ran just 130 words, short and sweet with little ambiguity. One of the things that he hit on a couple times too, besides price stability, is the housing market. And he said a lot of times uh, the housing market is not in line with what's going on here. And in reality, the housing market touches almost every sector out there, whether it be, furniture, lumber, even, oil, gas. I mean, all this stuff, because when somebody purchases a home or a home is built and somebody purchases it, that has an effect on the economy, obviously, and other businesses, other companies, because of everything that goes into not only building the house, buying the house, but filling the house up with things, and all of the things that go into all the other sectors around that house and community. So he did bring that up a couple times, and he did say that the data is going to be very important. The communication is going to be very important. The not having this forward guidance and these dot plot things is going to be a very important piece of this. So, at first, and it makes sense. He would sound hawkish right now with the way everything's been going on with the Iran thing over the last few months, with the inflation rate being higher, and with all the critics of well, he's just going to try and lower rates. Well, that wasn't the tone he had. You can say what you want, whether it was an act or not, but it totally made sense that he had the stance he had, along with the other Fed governors right now. Let's kind of just take a wait and see approach before we lower things down. But I think eventually they're going to see with the with getting that better data with these task forces, better communication, better strategy, better balance sheet, all that for the Fed. I think we're going to end up in the long run seeing these rates come down. And he said it may take up to, the end of the year to actually have all this stuff implemented with these task forces. But, that totally makes sense too. But in the coming couple of months, we should start seeing some of this filter in. The next Fed meeting won't be for about another 6 weeks. So we'll keep an eye on that and track all that for you. So right now, actually, I should have put this over here and this here. Sorry. Okay. So the oil prices, this is the big thing going on this week. So right now, we're sitting at about $77 a barrel. That's good. Over the last week, we can see how much this has come down from where we were. And over the last month, huge reduction in oil prices. And that really sets the stage for everything because we're dealing with oil, we're dealing with, diesel fuel to operate machinery, to operate, deliveries, to operate things like fertilizer and all that with diesel and those sorts of things. It affects, food costs, transportation costs, shipping costs, all that stuff. So super important. And then, of course, the gas at the pump, which now I know last time I filled up, it was $3.90 a gallon. So that's good. It seems like it's getting better. So it's nationally under $4 a gallon. So good starting point there. That'll really set the stage as that comes down even more. Hopefully, we see a change in the inflation rate. That's really a big driver, right? So moving on to the next piece of this would be the 10-year Treasury because we want to track this. Why? Because the 10-year Treasury is typically a spread between the 10-year Treasury and 30-year mortgage rate of about 1.6 to 1.8%. So that means that today we're ending at a 4.45%. Okay. So we can see just in the last 5 days here how this has dropped off. This was up a couple extra points. So we can see it really dip down here. And over the last month, we can see how this has really come down. So that's a good news because that will mean that our mortgage rate should look better. And looking at the 30-year mortgage across the country, the average across the country right now is 6.5. We are at 4.45. So right now the spreads are a little bit elevated, a little bit higher than we want to see them. But as the economy gets better with this whole Iran thing being over, hopefully it stays over, we'll see those spreads get even better. Okay. So just with the pure spreads in the economy, we should see these rates get better. Now, if we want to know what can I get, is that the best rate I can get, Chris? That's the average across the country for the 30-year. Okay. And usually when you hear about rates, they typically talk about the 30-year. But if we look at it all broken down, and this is actually taken from the 15th, this would actually be a little bit lower today. This would probably be about 5.5 today from our mortgage broker here locally in the Phoenix area with Andrew Fisher at Semperfi Home Loans. Okay. So today he's probably at about 5.6, 5.5, right around in there. FHA was going to be probably closer to 5 today than this number at 5.2. You always want to look at the APR because that's where you're getting charged all the fees. And he has some of the lowest fee structure around. So, whether you're buying or even if you're listing your property, this is one of the things we stress in here when we have people coming through our open houses or that we're talking to online or whatever when they come through. That we can get you a lower rate. So then it helps to alleviate some of the idea that we're going to have the buyer ask for a ton of concessions or need those because they're getting much lower rates. I mean, you're looking at 6.5 nationally, and here, you're going to be at 5, just out of the box, not doing any buy downs or anything. Out of the box, you're going to be about 1% lower on this, and then we have FHA, VA. Again, these numbers are going to be a little bit lower than what you're seeing on here. Um, closer to about closer to 5%, 5.1, right in that range on these two for the government loans, and the conventional is probably going to be about 5.5 to 5.6 today. Okay. And looking at the ARMs, he's also got some ARM products. So conventional rate 5.1, that's for 5 years. Okay, you can get through this rough patch with these lower rates right now. And again, if you're a buyer, we can try to get these negotiated in even lower with concessions for you. If you're a seller, we get people through the door. We're going to promote this so they have more buying power, and there's less of a chance of you having to get soaked on the concessions, because right now in the greater Phoenix area, about 53% of homes that are selling are paying concessions. Okay. And the average number is about $10,000 in concessions. Okay. That's not a price reduction, although it comes off your net, but it's a concession of around $10,000 is what you can expect about 53% of the time. Okay. Higher price points, not so much. At the higher price points, probably like 800 to a million on up. All right. Not so much. 800,000 to a million on up. Not so much. Okay. So FHA ARM 4.75. Again, these numbers are probably a little bit better today. This was like 4 days ago when I got these rate sheets. VA 4.7. So these are probably, again, this is probably closer to 5. This is probably about 4.4, 4.5 to 4.6. Same thing with VA. Also, on top of this, if you're buying, he's got a great grant program you can throw alongside of this, where you can basically get $10,000 to use to pay off debt, pay your closing costs, buy down the rate even lower. So there's a lot of different ways you can use that grant. It is a true grant as long as you don't sell the house within 5 years, which most people, if you're going to buy a house and sell it in less than 5 years, you probably shouldn't be buying a house. Okay. You probably want to be in the house at least 5 to 7, 8 years to get, your equity out of it. All right. All right. So I'm going to talk about the national, and then I'm going to compare it in detail with the Phoenix metro area statistics. So we already talked about the 10-year treasury, uh, the mortgage purchase index. Right now, if we look at this, let me just take these out. Right now, mortgage purchase index is dropped off a little bit this week. It's a little bit lower than we'd like to see it. We compared to last year, we're up a little bit, and compared to the year prior, we're still up a little bit. So that's mortgage purchase applications, people applying for home loans. That's a trend line. Tells us sort of what's going to happen in the next 30 to 90 days. It gives us a trend of where we're headed. So good signs there. All right. National inventory, a national single family house inventory is up. Okay, so but it's gone negative here as of the last couple weeks since the holiday, Memorial Day. The national inventory's actually gone negative. And again, I'm going to compare this with the local market here in just a minute. Jobs claims have dropped off just a little bit. That's important because of the dual mandate of the Fed. Okay, steady costs on everything, stability in prices, inflation, and the full employment. Okay, that's the dual mandate that Congress gave the Fed. Okay, looking at new fresh listings. Okay, we've actually got a little bit of a spike going on right now there, and we're a little bit over last year, not by much. But this week we're at 81,000 and 800 homes. So that's actually good. You want to be between nationally about 80 to 110. 80 to 110 is the range we want to be in. So we're right there. We haven't been right there consistently for a while. Okay. But we are right there this week. Home price reductions. So if we look at it this year, okay, we're just over that 35% mark. So right now we're at 38% are doing home price reductions. As of this year, we're actually have a little bit less than the year prior. All right. At the same time, we had just a little bit more the last year, and then the year prior to that, we actually had less. Okay, in 2024. All right. So pending sales, pending home sales across the country. Here's where they are right now. They actually, pending home sales just dropped off a hair. Looking at it year over year, we're actually up. Okay. Uh, pending home sales, that means properties under contract. Okay. And for the year prior to that in 2024, we're up over that. 30-year mortgage versus the 10-year spread. Okay. Again, let me take these out. And if we look at year over year, we're lower. That's good. We want to be at a lower number there. The spread between the 10-year treasury, the bond market, and the 30-year mortgage rate. So we're good there. Right now, it shows us right around that 2 mark, which tracks with what we just talked about. Again, we want to be more in between 1.6 to 1.8, but still good. This is the one of the big news things of the year, the last year, last 12 months, is that the mortgage spreads have gotten better between the 10-year and the 30-year. If they were not, and a lot of that had to do with Fannie Mae putting in that 200 billion that President Trump told Bill Pulte to put it in there into the bond market, and that's helped along with the economy, that's helped to keep this in check. Okay. And notice they did that right before the Iran war. So it's all calculated. All right. So that's good to know that they're actually calculating these things. Now, looking at the greater Phoenix area, I'm going to give you a comparison here after I run through this really quick. But 78 days is the average close days on market, 78 days on market, okay, to close a property. So a little over 2 months. 4.17 month supply. If we get under that 4 month supply, and I'd say closer to about 3 months supply, we're in a seller's market. But technically, historically, anything under 4 months is considered a seller's market. Okay. But we're not quite there yet. I'd say more like a 3 month is really in our area more. And we're going to talk about why in a second. 25% absorption rate, that's actually up. That's pretty good absorption rate. Average list price is 759,000. Average sales price of what it actually sold for is 622,000, and the list to sales price ratio is 97.15. So sellers are giving up about 2.85% on their listing price. Remember, listing price is the starting price, the invitational price, whatever it's listed at in the beginning or with price reductions or whatever. Right now, with things sitting at 78 days closed on market, looking at the overall picture, which we'll talk more about in a minute, you definitely want to price aggressively. It's not a kind of, hey, I just want to kind of test the market out type thing. It's not, we're not in that kind of market. Okay. Overall, I would say it's still more of a buyer's market right now with the supply that we have coming online, and we can see the active inventory right now is up at 0.3% with 25,000. So we're actually pretty inventory heavy. I wouldn't say it's over heavy, but that's a good hefty amount. And when we look at the national numbers, it's different. We'll look at that again here in a second. I'll compare it for you. Pending is down 1.6%. Okay. What's actually under contract is down 1.6%. Again, getting out of the spring market, ours starts a little early than like up in the Northeast. They had the snowstorm too. That kind of slowed things down for them for a while. They've actually got a very low inventory situation up in the Northeast compared to us here. But 42,000, I'm sorry, 4,282 homes under contract this week over week. Closed units, 3.4%. positive to the positive, 3.4% up at 2,878. Okay, distressed properties, they're up a little bit. Nothing that's crazy concerning or anything, but definitely up a little bit in the positives here. And the HUD homes, those government contract type homes, they're actually down 13.3%. So you can look at all the price ranges down here below. 66.74% is from 600,000 and below. That's the total inventory price ranges. And then from 600,000 to a million, we're at 19.5%, 5.3%. I'm sorry, 19.53% of the total inventory is between the 600 to a million, and a million plus is 13.74% of the total market inventory. Okay. So looking at this chart, the rule of thumbs are over here. We had plus 2.5% for this week, and we're at 2014 homes, new listings. Rule of thumb is 2,400, so that's a little shy of the rule of thumb number, but a little bit more than last year. Okay. Um, we can also see that um, all of the other categories here are looking good for the new home construction. This is always a good one because that's actually real new inventory, new home construction. A resale, typically 70 to 80% of those people are going to buy a home, so it kind of negates a little bit. But when we see the new home construction that's fresh, we want the rule of thumb is 8.6%. We're at 3.1% right now. Builder confidence is about 35% on their rating system. Anything below 50 is really dismal. And we can see that trend all the way back to 2022 when the rates, the highest, fastest rate hikes that we've had in history went up. And from there, the builders are not the march of dimes. They're, in this to make money. So they're not emotional though. So they have all the incentives. It's really a different market than resale because they're offering tons of incentives. I mean, you can buy a brand new home right now with anywhere from, I've seen as low as 1.9% your first year, second year, 2.9%. Some of them have fixed rates between 3 and 4%. So, offering down payment assistance, all kinds of different things that we're showing our clients too. But right now, that number is definitely below the rule of thumb number that we like to see. We're up a little bit over last year on the new fresh listings though, and we're down from 2025 and 2024. Okay, new build construction. So now that this Iran thing's over, if rates drop, building costs come down with the whole oil shock of the global economy. Even though we're the biggest exporter and we produce plenty of our own oil, we're tied in with all that. So it just affects all of this stuff. So we can see under contract actually is down 1.6%. This last week we had 4282. The week before we're at 4352, so that's dropped down 1.6. But we're up over 2025 and 2024 on what's actually under contract when you look at the actual numbers. So that's good. Closed month supply, the actual close, we're at 3.4% more than we were the week before at 2878. And we're up over the previous year and the year before that in 2024. Okay. Not by much, but we're up by about 100 homes, give or take a little bit. Okay. So you got a little bit more in the way of closings, a little less in the way of pendings this past week. So overall, there's a little bit more buyers out there right now than there was in years previous, but the percentage is down a little bit. Okay, so we got to make sure we look at the actual number, though. We can see year over year, the last 2 years are actually up on the pendings and the closings. Okay, so not by any crazy big numbers, but we're up. Month supply, we like to see it we'd love to see it between 2.5 to 3, really keep a brisk market going. But right now we're at that 4.17. That means the month supply. That means if everything were to sell, um, and no new homes came on the market as of today or this week, we have it would take 4.17 months to get through all that inventory. Okay. So we're up a little bit over the last week, and we are actually down a little bit over the last year and up over 2024 a little bit. Okay. So list the sales price retention. Like I said, we're at 97.15. Last week it was 97.42. So sellers are giving up just a hair more in their price reductions, and we are actually down a little bit from last year and the year previous on that list to sales price ratio. Now, looking at this and kind of plugging it in and comparing it to the national numbers, I went ahead and did an analysis on this. National NAR, National Association of Realtors, and HousingWire, Logan Mohtashami over there, looking at their two chief economists, pointing out to improving demand nationally. May pending home sales rose 3.8% month over month and 4.8% year over year, with Lawrence Young calling it a late spring buyer rush, and evidence buyers are adjusting to 6% rates. That's the average across the country. Again, you can always get lower with mortgage broker, or you can get those negotiated in lower. Logan Mohtashami's recent national theme also has been the demand has stayed positive while inventory growth has slowed or even turned negative year over year. But the greater Phoenix area looks different. Phoenix inventory is still heavy. Okay, we talked about the 25,000 up 0.3%, which we talked about 4.1 month supply. That is much looser than the inventory constrained national story. Okay, so we have more inventory. Uh, Pending demand, so that gives more options for buyers, and it also takes longer to get a home sold when there's just more inventory. Okay, that's basically what that supply and demand. Demand is weaker locally. Phoenix pending home sales down 1.6 week over week, and down sharply compared to last year on the slide. Nationally, pending home sales just posted a strong May gain. Phoenix is not seeing the same buyer rush. So closings, number three, closings are stable but not booming. Closings month to month up 3.4% week over week, which is positive, but the market is still moving at 78 closed days on market and 97.15 list to sales price retention. So that says buyers are buying, but they are negotiating and taking their time. And that is for sure. And they're very picky, and they are going to look at everything on that inspection report. And if you have an original roof, inspectors are going to call it out. And a lot of them are going to look at that and say, well, things like that. They're going to look and say, well, maybe I should get a credit, or, maybe I should ask for the roof to be replaced. That's happening, guys. That's happening a lot. So we're seeing that a lot anecdotally, and a lot of other agents have been saying the same thing. So you got to have a strong agent to protect that, and there are ways to negotiate that, which we can certainly help you with. Phoenix is more price sensitive. There's also ways of getting ahead of that too. Which you could do your own inspection ahead of time, get a handyman or person in there to make sure everything's tip top shape. You may not be, you're not replacing a roof unless it's totally failing, obviously, but other things can be taken off. So you don't have this laundry list of other things that maybe need to be actually fixed. All right. Never a bad idea to get ahead of those things too. Phoenix is more price sensitive than the national headline. All right. The strongest inventory concentrated in is under 600,000, especially 400 to 600,000, but the higher price ranges are clearly slower. Luxury inventory has much higher days on market, with a million plus, mostly over 100 days. Phoenix is closer to a buyer leaning balance market. The national conversation often focuses on tight supply supporting prices. Phoenix has even I'm sorry, Phoenix has enough supply that sellers must compete on price, condition, concessions, and presentation. Okay. And I tell you, the three big things with selling a house, is you're going to be your invitation listing price. That's the invitation price. Your marketing, obviously your marketing, and part of that has to be how does the home actually show? How does it look? How does it smell? All those sorts of things. How's it maintained? Am I going to walk in and see a bunch of dirt on an air return? Weeds everywhere, those sorts of things. Okay. How does it present? Does it smell like the cat, the dog, whatever? Okay. Love dogs, got five of my own, but that's a thing, right? And a lot of times you don't smell your own smells. Got to make sure that pool's clean. Got to make sure it shows well, okay, and everything looks like it's been taken care of. Otherwise, it's better. It's cheaper to do that than what buyers think I need to tick off. Okay, they look at, oh, it needs a paint job, $10,000. It doesn't cost that much to paint it, but that's what they're thinking. So the other thing is pricing, marketing, or how it presents. And our approach is all inclusive, so old school and new school. We want to do some of the old school stuff because it cuts through a lot of the noise. Okay. The open houses still work. A lot of people come in unrepresented. Okay. A lot of people come out without their realtors through open houses that are seriously looking. They're serious buyers. Maybe their realtor's not available. All those sorts of things. So you want them to see your home first. If you're open and the other one's not, just saying, those things still work. Doing the door knockers in the area. People may know somebody else who wants to move into the area, or somebody may want to buy an investment property. Those things still work. Okay. Um, you know, Calling through the neighborhood, before the open house, create an event atmosphere and some buzz in there. Yes, the digital, online, working with the algorithms, working with AI, because that's just how people are searching now. We have to, pivot to all that too on our end. So we have to make sure all the digital stuff's out there on all the portals and platforms, but now through AI too, and we're doing that. Social media, that's another big thing, and not just organic. It has to be, paid, targeted. And there's buyers that we know. In other words, buyers in our database, buyers that have come through open houses in your area when you're selling a home, that we have talked to, talking to the other realtors that have buyers looking in the area, that have sold properties in the area, that have pending sales in the area, because they probably have other buyers too. That's part of our due diligence as the realtor, to make sure that we're making all that happen for you. And then there's that social media aspect where we're targeting, and we can tell, we know this house is going to be a first time home buyer. Maybe it's a 20-year-old house, it's a two-story, but it's a big house, young family. Old people are not going to buy a two-story house. Maybe if it has a downstairs bedroom and bath, sure, or a next gen. But typically, if it's a two-story house, it's not going to be an older person buying it, and those sorts of things. So there's a lot that goes into it, and we can target, kind of a blanket target, but a targeted approach of the type of buyer demographic that's going to come into your house. Okay, for sure. So old school, new school. You got all the old school stuff, the digital and the social media and the AI. Okay. Phoenix is closer to buyer leaning balance. All right. So those things are, best uh, takeaway here is the national market is talking about improving demand and tighter inventory. Greater Phoenix is different. The Greater Phoenix area is different. We have more supply, softer pending activity, longer days on market, and more negotiation power for buyers. Prices are not crashing, but this is no longer a seller's controlled market. It is. a normalized, competitive, buyer sensitive market where pricing strategy matters. And with pricing, think about how people search online, guys. They don't put in 799,500 or whatever. They search in 25, 50, and $100,000 blocks. So from 400 to 500,000, okay? Or 450 to 550. If you're $1 off or $100 off, they may miss your house completely. There's also a thing that we call the trending market, where we look at the pending sales and we figure out by doing some recon how many showings were in their area. We can actually pull that data. We can talk to the agents and find out how much traffic they actually had through their open houses and those sorts of things. So there's a lot that goes into it. And it's important that you have a strong realtor that knows how to get the property sold. Now, a lot of sellers may not, listen to the realtor, or they may just need a certain amount out of it. I totally get that. It's not my house, it's your house. And you need to get what you need to get to walk away out of it. But if you want it sold, there's certain things that definitely need to happen at a certain price. Okay. So looking at the Cromford Market Index, right now it puts us in a buyer's market. Below 90 is a buyer's market. Over 110 is a seller's market. Right now we're at 81.7. Okay. 100 being totally balanced. 90 to 110 is kind of a balanced range on their charts. And it's based off supply and demand and their algorithm, and data here. So right now our supply is up 4%, almost 5% at 104.9, and the demand is at 85.7. So that's definitely down about 15 points there on the demand side. Okay. If these two numbers are the same, this number is at 100. Okay. So that's where we stand today, guys. That's the long and short of that. Looking at the contract ratios, this tells us more of where we are in the right this moment. And this right now is telling us that what's active for sale and what's actually under contract right now puts us at 36.3. Anything over 30 is considered warm, sort of a warm or balanced range. And basically, that means, it's kind of more of a balance to buyer market because there's more active properties than there are under contract, basically. And looking at the heat map of the greater Phoenix area, we can tell you exactly what's happening here. And that is, up here, in Scottsdale, it's hot. Down here in South Phoenix, 85045, it's hot. There's a couple of areas up here in North Phoenix that are hot. And then El Mirage or Youngtown has a hot spot. Everything else is mostly warm in these other areas. And then the blue to gray, that's all cold. Okay. So that's your shot at the greater Phoenix area market. If you guys have any questions at all, feel free to reach out to me anytime. I love questions. I'd love to be able to come to your place, take a look at it, let you know what it would take to get your home sold, what you could walk away with, and what we would do to get it done for you, what that all looks like, the timing, everything. So guys, we'll see you next time.